Hello, guys. I'm back with yet another theory topic from your AFM syllabus. Now, I want to ask you a question. Are investors truly rational? I mean, we make that assumption in almost all the theories in AFM that investors are rational. But are they? If they were rational, would people buy lottery tickets? Would people panic sell, when they get some news that foreign institutional investors are pulling out of the Indian markets? Would people chase IPOs just because everybody else is chasing them? No, they wouldn't, right? But they still do. And why is that? This is where behavioral finance comes in because it accepts the fact that we are not robots. We are emotional, we are impatient, we are overconfident, we have herd mentality, and these emotions drive the market. Not everything in the market is data driven. Unfortunately, I mean, it should have been, but it isn't, which is why we need to discuss a concept which combines psychology and finance, in short, behavioral finance. It combines traditional finance concepts with how the human mind works. It helps us understand why people make irrational decisions, even when they know better. See, traditional finance always has always assumed that we as human beings are rational, right? That we look at data, that we assess risk, and we make the smartest choice possible. Do we? I don't think so. Because when the market crashes, when Sensex crashes, when Nifty crashes, fear takes over. Logic, it flies out of the window, it's jumped out of the window. And this is where behavioral finance steps in. It explains what is happening inside an investor's mind. Now, go back to March 2020 when COVID hit. The Nifty crashed from 12,000 to 7,500 in days. Investors panicked and they sold everything. Most of them, rather. 6 months later, the Nifty was back at 12,000. Those who sold, they were in fear that, it will go down further, we'll have nothing at the end of it. So they sold. But they also missed the biggest rally of the decade. There was no analysis. There was emotion, pure, raw human emotion, survival instinct. And the understanding of behavioral finance, we are not going to discuss as to, should we remove the emotional aspect out of it? That's not possible. We are not robots. The goal is to understand how human behavior, how human psychology ties up so brilliantly with the quantitative aspects of finance. And if we manage our emotions, we can manage our money. So let's look at some of the common thought processes that we as individuals could have when we are dealing in the financial markets. The first one is anchoring. Now, investors have a tendency to attach themselves to a number that is always their reference point, something that might feel like a safe spot to them. Now, if you have ever seen a bank, sorry, if you have ever seen a boat, what happens is when that boat is traveling and it wants to, when they reach the when they reach the seashore and they don't want the boat to drift away, they drop a device in the ocean, which basically makes sure that the ship stays at one place. That device is called an anchor. And this is where this term comes from, that investors have a tendency to attach or anchor their thoughts to a reference point, even though it may have no logical relevance. Now, if a stock that once traded at 1,000, it is now trading at 500. Investors think that it's a bargain because they are anchored to that 1,000 number. They believe that no, it will go back there. A perfect example, Yes Bank. The price fell down from 350 to 150. People thought it used to be 350. That is the number that we are attached with. That is the number we are most comfortable with. We know it will come back. You don't know the power of markets. They will bounce back the stock to 350. It never came back. They ignored reality. Anchoring blinds us to what is actually happening. Then there's gambler's fallacy. Investors have a tendency to believe that the probability of a future outcome changes because of the occurrence of various past outcomes. Example, if the value of a share has risen for the last 7 consecutive days, some investors might sell the shares believing that the price is more likely to fall on the next day. Now, when I say gambler's fallacy, what I'm trying to put across is that somewhere people try to draw a pattern of sorts, that in the past this share has gone up and down, went up for a month, fell down, went up for another month, fell down, and they try to attach that, okay, if this is the pattern that has happened in the past, this is the probability of how outcomes are going to change, and The future outcome depends on the past outcomes, is what their belief is. So they believe that right now it has gone up and it has reached a high point. It won't rise beyond that, it will fall. I mean, a couple of months ago, I myself was subject to this thought process. I was looking at HDFC Bank shares, and HDFC Bank, I purchased the share at 1600 and it consistently went up 1600, so on. At one point, it crossed 2000, and now I felt no, this the price will fall down. It has to fall down because that is what has happened in the past. But that is not what happened. The price still continued to go up till the bonus issue was happened, and then it reduced. That is a separate story altogether. But still, somewhere in my mind, I expected that to follow a pattern, which was not the case. Herd mentality, I mean, who better than human beings and students to follow herd mentality? We Indians love validation. Okay, if everyone's doing it, we must do it, and that is, if everyone's doing it, it has to be right. That's how the IPO mania happens. Remember Paytm's IPO in 2021? People subscribed it just because everybody else was subscribing it. Oftentimes, when I ask people, what was your reason for a particular action? There is no confident response that I get from them. Mostly what I get to hear is, what, because he did it and he said it's right, I am also doing it. The FOMO thing also pushes us to do something which otherwise in our rational minds we wouldn't do. Paytm IPO was listed at a 27% discount, and what worse than her, I mean, herd behavior brought out the worst of your fears in front of you, right? I mean, we Indians, now that Diwali is coming or there is Akshay Tritiya, that's when, everybody does gold shopping. Why? Because everybody else is doing it. We don't act because we want to do it. We are following the example of the crowd, and that's not the right way to, necessarily respond. Then overreaction and availability bias. Okay. Now, we love to react before something happens, and we love to overreact because, again, it is the survival instinct that kicks in, nothing else. The next aspect that affects human behavior, of course, we were talking about overreaction and availability bias. We humans react instinctively without even understanding the cause behind a particular incident. Okay, now according to the efficient market hypothesis, all available information is instantly reflected in the price of a security. That means if new information comes out about a company, its stock price should immediately rise by the exact amount justified by the news. If similarly, if there is a negative information, the price should instantly fall to a new fair level. Efficient market hypothesis essentially says that you cannot beat the market because prices already incorporate all known information. But we know that this is not how it works in real life. In real world markets, including the Indian stock market, investors are human, they are not machines. So instead of adjusting prices rationally and instantly, we tend to overreact or underreact to the new information, which leads to price distortions for at least the short term, where prices move more or less than they should before eventually correcting themselves. That's why behavioral finances markets are efficient in the long run and emotional in the short run. I mean, go back to the Hindenburg report. When the Hindenburg research report was released in Jan 2023, it alleged accounting and governance irregularities in the Adani group. Now, according to EMH, that is efficient market hypothesis, the markets should have analyzed the report, assessed the likely financial impact, and adjusted prices rationally, and that too immediately. But what happened instead? Investors overreacted massively and the shares fell over 60% in less than a month. And the combined market cap of Adani Group dropped by over 10 lakh crores. Now, was every company in the group equally affected by the allegations? No. But the reaction was emotional, driven by fear, not logic. See, later as clarity improved, fundamentals were reassessed, some of the company's prices recovered. But there was overreaction. When RBI first raised concerns about Yes Bank's loan book in 2020, in 2019, the news triggered panic. Investors didn't stop to analyze how much of the non-performing assets would actually hurt the bank. They just started dumping the stock immediately. Yes Bank's share price crashed from around 150 to under 20 within months. Later, when SBI and LIC stepped in to recapitalize it, the prices bounced back sharply. This sequence, this crash, then this rebound, it shows classic overreaction followed by correction. I can quote the example of Infosys also. In 2019, an internal whistleblower report alleged unethical accounting practices at Infosys. The stock, it dropped almost like 16% in two trading sessions. But within a few weeks, when the investigation showed that there was nothing wrong, the stock recovered again. So basically, what happens is the new information comes in, the market overreacts without analyzing the cause or anything behind it. Then when some add-on report or when some other information is released, then the price comes back and it gets back restored to its original state or even higher, and then the correction happens. So basically, human beings don't their amount of quantum of their reaction is disproportionate to the fact at hand. And that is why I think the overreaction bias is something which can hurt the markets in the long run. Then let's talk about confirmation bias. What is confirmation bias? See, first the theory and then the psychology. Okay. And how Indian stock markets react. See, confirmation bias means we naturally look for, notice, and remember information that supports our existing beliefs and ignore or dismiss anything that contradicts our beliefs. We see what we want to see. Once our mind forms an opinion, whether it's about a stock, a company, a person, it becomes very hard to shake that first impression. We start searching for proof that supports our conclusion. Even if there are evidences to the contrary, we don't rely on them. See, it's our human nature that we want to feel right. Admitting we may be wrong feels uncomfortable. It creates a certain amount of cognitive dissonance within our heads. We can unconsciously filter what we see, and we pay more attention to positive news that supports our belief. We rationalize or we downplay negative information. We stop seeking opposing viewpoints, which is why confirmation bias is so dangerous. Now, let's say that an investor strongly believes that Zomato is the next big tech success story in India. They will follow Zomato fan pages and bullish Twitter handles. They will read only optimistic posts about revenue growth. They will ignore analysts who talk about high losses or poor unit economics. And when the stock dips, they'll say it's temporary. It's now is the right time to buy more. This one sided consumption of information keeps reinforcing their belief even when the fundamentals might say otherwise. Right? So when reality hits, they realize that it's a poor earnings sector, and they are caught off guard because they ignored the signs that were there all along. They did not pay attention to that. See, when Jet Airways started showing signs of distress, loyal investors and analysts rationalized it. It's a temporary issue. Naresh Goyal will find a new investor. They ignored the warning signs: unpaid salary, grounded aircrafts, missed payments. Those with confirmation bias held on for far too long, believing it was just a matter of time before recovery. By the time the reality set in, the stock had collapsed from 800 to under 30. Now, confirmation bias does not just affect decisions, it distorts the decision making process because you only see one side of the story, right? Your frame of reference is incomplete. You start believing your version of reality, your version of thoughts. You don't pay attention to what the actual situation on the ground is. You should look for people who are neutral. You should seek guidance from individuals, who might have an opposing viewpoint, because that is what is going to help you. Otherwise, you will be doomed in ways that you cannot even imagine, right? And somewhere this approach this approach has to be incorporated in decision making. Otherwise, we will end up with the same problems again and again, and our wealth will get eroded before we even realize what is actually happening on the ground. Then hindsight bias and overconfidence. Well, I mean, talk about overconfidence and us Indians. Hindsight bias occurs in a situation where a person believes after the fact that the onset of some past events was predictable and completely obvious, whereas in fact the event could not have been reasonably predicted. See, this is where things get really dangerous. Hindsight bias. So, how hindsight bias affects the thought process and how overconfidence is what kills you, let's understand. Hindsight bias is the tendency to believe after an event has happened that we knew it all along. It's that voice in our head that says, of course the market crashed. It was obvious. Anyone could see that the stock was a bubble, but the reality is, before the event occurred, it wasn't obvious at all. We reconstruct our memories after the fact, so our brain convinces us that the outcome was predictable. This creates a false sense of foresight, a feeling that we can see things coming like a clairvoyant of sorts, but it's not what is happening. The human mind, it hates randomness. We like stories that make sense to us. So after something happens, we mentally rewrite history to make it look more logical and predictable. This gives us comfort because somewhere it makes us feel that it's more comfortable for us. But the danger is, once we start believing we knew it all along, we become overconfident in our ability to predict the next event. That's how hindsight bias directly affects overconfidence. It becomes overconfidence, which is a deadly combination. After every market boom or crash, you will hear investors saying, what, we knew it, it was so obvious. But if you check what those same people were doing before the event, most of them were blissfully unaware. Hindsight makes the past look neat and predictable when in fact it has been extremely unpredictable. When the Harshad Mehta story broke out, people said, what, market was rising too fast, it was so obvious, and all of that. But you know what? Newspapers were calling him the big bull of the Lal Street. I mean, hindsight makes us believe that we are smart, but the truth is we aren't. After the 2008 global financial crisis, people said subprime lending was obviously unsustainable. Anybody could see the house bubble forming. But if you could see the house bubble forming, why did you participate in it? You could have stopped it, right? Adani Group's stock fall after the Hindenburg report. People are like, oh, you know what? I knew it. The valuations were too high. You did not know it. Or the startup IPO wave after Paytm, Car Trade, most recently Jaro, all these IPOs fell post listing. Retail investors said, obviously they were overpriced, which is why they fell. But before the listing, social media analysts and retail chatter were overwhelmingly positive. Everybody was chasing the allocations, everybody wanted that. And the combination of hindsight bias and overconfidence, that combination is what is so dangerous. In investing, overconfidence means thinking you have superior stock picking or timing abilities without evidence to back it. If it makes investors take larger risks far more than what their knowledge or ability supports, and it can completely distort the reality for you, making it far more difficult to, damage control whatever has happened in this process. And behavioral finance seeks to examine the assumptions of rational decision making by investors and financial managers. That financial decision makers seek to maximize their utility and to do so by trying to maximize portfolio or company value. This is an assumption. Investors don't operate in this manner. They take financial decisions based on analysis of relevant information. They don't. They are stupid people who are driven by emotions, and the analysis of financial information that they undertake is rational, objective, and risk neutral. Nothing could be further from the truth, in my opinion. Now let's see how investors make their decisions. Okay. Now investors, they are expected to take rational decisions. Behavioral finance may influence investors to take decisions that are not the best ones for achieving maximum value with their portfolios. How many of us how many of us know people who worked on tips, who work on, the advice they got on Telegram groups? And you know there is this human mentality that shapes their thought process, and that changes the approach, that changes the way we look at things. I mean, there are people who would avoid sin stocks, companies operating in sectors that they regard as unethical. Someone who is not a fan of non-vegetarian food would avoid companies, which process non-vegetarian items. Vegans would do that. Or preference for stocks on non-financial grounds. Examples, companies that they consider are acting with social responsibility. Again, nothing personally against the founders of the company, but Infosys is, built. Of course, it's a great company and all of that, but the Murthy family has consistently portrayed themselves as these simple people who are, building something great, who are building a greater cause, and who are very, very socially responsible. I mean, that is a reality about them. I'm not questioning that, but a lot of times people want to invest money in Infosys because they believe that, this is a company which is run by people who have certain values, that they hold dear. Cognitive dissonance is holding on to shares with prices that have fallen over time and are unlikely to recover. They may do this because it will cause them psychological hurt to admit, even only to themselves, that their decision to invest was wrong. I I hope this is not happening with me. Uh, I have a certain amount of confidence in the shares of Geofinance. Now, the share price hasn't really risen in the last couple of months the way I expected it to. In fact, it has only fallen from the day that I have been purchasing it. But somewhere a part of my mind is like, you know what? Now they are falling, they will go up. Now is the time to accumulate Geofinance stocks. And this cognitive dissonance is basically, I can see that the prices are falling, but I hate to admit it to even myself that, you know what, Satyamed, you were wrong. Your analysis of this stock was wrong. So I continue to hold the share without understanding the actual consequences of the fact that, the share price looks like it will fall down. We discussed anchoring gambler's fallacy in the previous tab. Then, of course, law of averages. Investors may also believe that the probability of a future outcome will be influenced by how often the same outcome has occurred in the past. See, you can apply that to certain laws in mathematics or physics, but it doesn't necessarily apply to financial markets. The rise and fall of share prices does not necessarily follow an average, right? For example, there is a news about a massive project that a company is going to undertake. Vari Green Energies is a classic example. Now, the average price of the share was something else in the past, and people who thought that, it will remain in that range did not see this coming, that Vari Green Energies received lots of orders from state governments in different states for installation of solar panels. And because of the confirmed orders from state governments, the price went up. So the people who believed in law of averages, they could not foresee this coming and this leading to an increase in share price, because for them, the share price should have hovered around the original average number. Then noise traders, making poorly timed decisions and following trends. Chartism, using analysis of past share prices as a basis for predicting the future, is an example of noise trading. So basically, what we are saying is that people who follow too many charts, who are focused more on technical analysis, more on these patterns and candlesticks and all of that, they they don't incorporate the other news coming in about the company. They only look at the past data, charts, and trends to make decisions, and they in that process they completely end up ignoring that there are factors that are taking place in the world around you, which which are likely to have a deeper impact on share price than the past charts and trends. And then, of course, fund managers who wish to give the impression that they are actively managing their investment portfolios may periodically reposition their portfolios into new sectors, even though the old sectors continue to have good prospects. I mean, think about it. All of us create an illusion that we are working. The fund managers want to show that, they are actively making an effort to manage your money and build wealth for you. So they try to reallocate the funds from one sector to another, even though the earlier sector was doing really well. That's, of course, that's a very human thing, which I believe happens with the best of us, where, we want to create an illusion that we are working towards something bigger, and that creates a whole lot of that creates an illusion, but it is not really adding value. We saw confirmation bias in the previous tab. Regret aversion is avoiding investments that have the risk of making losses, even though expected value analysis suggests that in the long term they will make significant capital gains. Now, I haven't seen Tata Motors stock deliver bumper returns. So, even if there are strong fundamentals, even if there is positive news, confirmed orders, or the automobile sector picking up, I don't want to be in a position where the Tata Motors stock keeps on falling and I keep on losing wealth. So I stay away from that particular stock for fear of losing even more money. I would hate to be in a position where I regret the decisions that I have made. That is regret aversion. Then latest financial results, a lot of people focus on the a lot of individual investors who are investing, they primarily look at the latest set of financial statements, ignoring the fact that there are events that have taken place after the reporting date which are far more impactful on the share price, and those should be considered before going ahead with the investment decision. But they only rely on the latest financial results, which could be a challenge in itself. And then, of course, the momentum effect. A period of rising share prices may result in a general feeling of optimism that price rises will continue and an increased willingness to invest in companies that show prospects for growth. Uh, like right now, for example, like in the midst, Vari Green Energy stock was really, going up and up and up. So people thought that it will continue its upward swing, and they continued to invest in the shares of that company without incorporating the fact that the increase in share price was because of confirmed orders from state government, something that might not necessarily continue in the future. Well, it's not just individual investors who are the victim of irrational thoughts. Finance managers are no different. In fact, they are more susceptible to making emotional decisions than others. So, you know, the assumption is that managers want to maximize shareholder value, and I'm not contesting that in any way. But managers may instead try to maximize their own utility, their own bonuses, their career growth, reputation. They may prefer short term gains for their own self instead of empire building in the long run. And many Indian CEOs during the 2007-8 boom expanded rapidly through acquisitions just to increase company size. I mean, Anil Ambani's Reliance Power aggressively expanded during the IPO era to match Reliance Industries in size and scale. A move which was, I think, driven more by ego and image than by shareholder value. Uh, Somewhere, Vijay Mallya's Kingfisher Airlines acquisition of Air Deccan was more about expanding his empire than sound economics. There was self interest bias, reputation bias, overconfidence in the entire process. And behavioral finance has highlighted, how managers start off rationally, but later on, when they believe that it is their chance to shine in the sun and their moment of glory, there is a possibility that they will end up preferring maximizing their own wealth instead of helping in empire building. So when they say maximization of utility, the question is whose utility at the end of the day? Okay, now when it comes to analysis of relevant information, see, managers are expected to be rational when they analyze information, and they are supposed to be objective in the entire process. That's our basic assumption. Are we able to deliver that? See, in reality, they show confirmation bias and subjectivity. During Tata Steel's acquisition of Chorus, Indian media and executives celebrated it as India going global. Analysts who warned about overvaluation and the risky debt structure were largely ignored, and they tried to play the rationality card, but of course, nobody in the mainstream media gave them any importance. Within 2 years, global steel prices crashed and Tata Steel faced massive write downs. The IL and FS management in 2017-18, uh, they continued to borrow heavily and refinance loans despite internal signs of liquidity strain, believing that their rating would carry them through. And again, overconfidence in their own reputation and selective analysis of data delayed corrective action. Now, the expectation is that there will be rational, objective, and risk neutral decision making. But does it happen? See, there is often that overconfidence bias that nobody else before me could fix it, but I am going to be the answer to all your problems and I am going to fix it. Like, in the Jet Airways Air Sahara acquisition, Jet's management believed they could quickly turn around Sahara using their own managerial expertise. In reality, integration challenges, overlapping routes, cultural clashes destroyed value. You know what happened to Jet at the end of the day. Similarly, Bharti Airtel's acquisition of Zen Africa. Management believed their telecom management expertise could easily translate abroad, but there were regulatory and operational challenges that basically eroded years and years of profitability. Right? See, once a project or acquisition begins, managers often continue funding it, even when it's clearly failing, because admitting failure feels like a defeat. They want to prove that their original decision was right. They don't want their reputation to get impacted. And this is the sunk cost fallacy. I mean, Vijay Mallya kept funding Kingfisher Airlines even after it was financially unviable, right? To protect his image as a successful entrepreneur. Air India continued running loss making international routes for years, unwilling to accept failure. Reliance Communication kept rolling out new plans despite evident financial distress instead of cutting losses early. And what you can see is it is all driven solely by emotion. There are hardly any rational decisions that are happening. And finance managers are human beings at the end of the day. What makes you believe that if mere mortals like us can, fall prey to these bursts of emotion, what is stopping financial managers from doing it? In fact, overconfidence bias works even more. They believe that because they are educated and experienced, they know it better than most of us. The reality is they don't. See, critics of behavioral finance approach have argued that even if individuals make irrational decisions when left by themselves, participating in finance markets help discipline them to act rationally by giving them opportunities to learn. A lot of people feel that, okay, you made a wrong decision right now, but the market will reward you in the long run. It's not necessary that the market will reward you in the long run. Some shares have their value getting entirely eroded. Nothing is left in these shares. I mean, the very thought that most of us have, you know what, it hasn't, the price has dropped right now, but don't worry, it will work in the long run. That is where the problem starts. It does not, not everything is supposed to work in the long run. And we can't get the emotion out of the equation, that's for sure. But what we can do is we can work with emotion in a way that it helps us to maximize our benefit from a particular situation, and that understanding will help you take better decisions as a finance manager.